Our next panel, it brings together some of the brightest minds and most accomplished leaders in the field. Moderated by a significant, one of the best friends of the program, I think it's had over its entire time, Jacques Gordon, who's now at Madison, but continues to really play a great role within the Center for Real Estate here at MIT. And he will have alongside him Oliver Carr, Wayne Brandt, and Lisa Picard. So please, where they're going to share their perspectives on the current landscape and the emerging trends taking place within the industry. So please welcome all of them onto the stage. Thank you very much.
Just want to be able to see everyone's faces, and thank you, James, for that. It's just so much fun to be back. Yes, I live in Madison now, but I keep a house here, so back and forth is good. And just seeing Larry and Gary and Lynn sitting over there, and they're going to get their turn up here in a moment. It brings back a lot of great memories. You guys may remember I was the graduate student assistant helping you launch, and I remember Larry saying to me, we've got the class of 85 coming in. Would you please help teach spreadsheets? So Lotus 1, 2, 3 and Osborne Computers was all in a room, and I learned how to do spreadsheets the week before, because we were in Lynn's class. We did everything on big pieces of paper. Lynn, you'll remember that, and HP 12Cs, which I still think is a good way to understand how discounting works. But we did it, and we certainly had Aaron O'Boyle and a lot of great names. The class of 85 is really well represented in the room today, so it's great. What we're going to do here, though, is shift to kind of a little bit of a move up in the history of the program to the mid-90s. We've got a class of 91, 92, and 95 represented here on the stage with me. Three really interesting career paths, and also three people who have stayed connected to MIT in a way that we want to encourage more of our grads to do through both ACRE and through returning, as you all three of you have kindly done. So I really just got a lid on how long I'm going to ask each of you to speak. I'll be fidgety and interrupt if we get into any long speeches. But I did want you, Lisa, Oliver, and Wayne, to introduce yourselves and just give a high-level view of your career since you graduated from MIT, and just start by reminding us, what did you do at MIT while you were here? Because I think, Lisa, you've got an interesting story on that. And then what have you done since? Lisa, why don't you start?
Okay, I guess which one up here is not like the other? That's me. Let's see. So I came into MIT, I guess, with a background in city and regional planning. I sort of worked on specific plans in cities and came to MIT with sort of the vision that, like, I needed to kind of move up the food chain towards people who really started to control the environment. I thought it was developers. Later, I learned it was capital. But I came in doing a dual degree, master's in city planning, and then also the master's in real estate development. After graduating, I sort of figured that I needed to do the hard science of finance. I joined a small boutique firm in San Francisco that basically we did soup to nuts. So I got to do the acquisitions, asset management, dispositions, and it was really kind of a really foundational learning, because I got to sort of see that when you're an acquisitions person, you just can't toss it over the fence to an asset manager and expect them to make it work. Then I had a tenure at Hines. I got to build a couple million square feet before I was 30. And then the dot-com era happened. I spent some time in hospitality with Canyon Ranch and did some multifamily development. And then I joined Skanska, and Skanska had an interesting balance sheet where they'd used no debt and equity, and I got to build, as I called, crazy shit. That John Gray happened to walk into some of that crazy shit one day and said, we need people who know how to do this. I found myself running Blackstone's office portfolio for 5.5 years into COVID, really selling down the EOP portfolio for about 10 billion in assets, and then a year in venture, and now I've just started a new platform called Oxygen, because oxygen, well, cash flow is the oxygen to real estate. So anyway, that's sort of the foundation.
Wow. That's amazing.
Quick tour.
Yeah, a quick tour. 7 different companies and now a new one that we're going to hear more about in a moment. Oliver, quite different career trajectory for you. Would you give us an overview?
Yeah, I'd be happy to. Afternoon, everyone. Yes, I've been at one company since graduating from MIT, believe it or not. But I came to the center really to transform my career from what had been more of a corporate start in corporate banking. And then, I decided, hey, let's make the shift into real estate. I grew up in a real estate family, wanted to go the other direction into more corporate. And when I was accepted into the MIT program, I figured, destiny has arrived. So I, loved my time here at MIT. But I started a company with 2 fellow students in my class. And initially, we were focused on raising debt and equity capital in a time very similar to this, when the capital markets were dislocated, a lot of distress, no financing available. So we started a company to tie into the early days of the CMBS market. So that's how we first got started. Had a good run, 5 years or so in that business. The world changed. A lot of the lenders we were doing business with went away, got smaller, changed. So we were left with the decision, fold up the tent or let's try something else. And it was in the late 90s we shifted and got into acquiring kind of value add turnaround office buildings. So that's still mostly the business we're in today, but we grew that company. We took it public in 2005. After being public for about 18 months, we were acquired by JP Morgan Asset Management and taken private and rebranded as Carr Properties. And so today we're an office REIT shifting into multifamily. I got that message a little too late in my career, but yeah, so we're based in DC and operate in Boston and in Austin, Texas.
Well, thanks, Oliver. Wayne, yet another very different career trajectory for you. Could you give us that?
Sure, Jacques, and thank you so much for having me on the panel. It's a real honor to be here. And I really wish to thank Todd, Jamie, Denise for all the hard work that's gone into this, and all of you for attending. 40th anniversary is really a milestone, so it's really exciting to be here. Also wanted to thank you. Thank you for not putting any of our class pictures up on the, that would be rather humiliating for the class of 90. So
they were up at lunch, Wayne. I don't know if you noticed.
Okay, we're a little older now. But anyway, I graduated in 1991 from MIT. I wrote my thesis on commercial mortgage-backed securities. That was the time the market was just launching. And for 3 decades, I had a career in CMBS. So at a very young age, I was helping to grow these businesses. We were in charge of a lot of capital. We hired big teams. And it was a very entrepreneurial, kind of almost business startup at each one of these banks. And there were kind of 3 credit cycles that kind of marked what happened. So 1991, coming out of the center, and the expansion of credit in 2002, and then right after the GFC, when I joined Wells Fargo to help rejuvenate their CMBS program. So those leadership, positions were really formative, and it was really, really fun, and as I said, very entrepreneurial. Bought my first multifamily deal for my own account in 2013, just as a small investment. Then I bought another and a few more. These were all in Los Angeles. That's where I'm based from. And in 2020, I decided to start my own company or devote full time to my own investment platform, Capital Funding Partners. So I founded the company, and we're very focused on very disciplined approach, just Class A, Class B, multifamily in the Western United States. We have a different model. We're not a syndicator, or we don't use LP capital. It's a principal model. So we will buy the asset, and then we'll find how to match capital after we own it. My niche is between, the mom and pops and the 15 million. So it's not an institutional market. This is where private capital loves to play. So family office, super high net worth individuals, all that capital plays very well and aligns with kind of my conservative approach to building a company and a portfolio. So that's what I've done post CMBS and lending, and been very active. We invest in preferred equity, we do co-GP deals, and then we have 17 properties that we own on our own. I've been quite busy just the last 6 months.
Let me just interrupt. You use this phrase co-GP, and I heard all about it when Todd and I did a back to school with you in Santa Monica, and we actually got about 40 alums of Wisconsin and about 30 from MIT together. It was a great event, and you did explain co-GP the way you do it. But could you explain what co-GPs do? Yeah.
Sure. Well, I think in our niche, it may be a little different. What I'm finding is that there's a lack of liquidity right now for a lot of local operators who are really good and kind of emerging managers, but they're not big enough to be they're not big enough to attract LP capital of the traditional sort that maybe many of you use. But I have a hard time going into a market that is not my bread and butter, even though I probably lent billions and billions of dollars all across the Western United States and all over the country. To go into a market like Boise without a local operator, to me is a little challenging. So a co-GP would mean partnering with kind of boots on the ground, somebody that doesn't quite have the liquidity to recap a deal or raise it to acquire, and so we would joint venture with them. And we take kind of more of a patient view, cash on cash returns, low leverage. And this is the kind of capital that's looking for this kind of return right now.
But you're retaining a lot of approval rights and perhaps teaching them the business, and maybe they would aspire to do more outside of Boise someday. And they're learning as much from you as well as taking your capital. You're teaching them a lot.
It's exactly right. And I think what I've learned in this business, you can have, and I was a structured finance guy, so up and down the capital stack, Northeast, East, West. And now I've just learned it's about the people. And if you make really, really good people decisions in good markets and in bad markets, that is a better decision than whether you have just a pristine structure on your mezz debt. And so that's kind of been my insight, is that I really focus on alignment. Yes, we retain decision rights on major decisions and so forth, but you have to let your partner do what they do best. And so, you have the protection if things go badly, but for the most part, you make your money, you lose your money on that decision of who your partner is going to be.
Okay, well, it makes sense to me. It's certainly what sounds to me like it could be a pain in the ass to have you as a partner, because you're gonna be retaining all these decision rights, but also
not too much of a pain in the ass, just a little bit.
We're already way off script here, but I'm just going to stay with it. Because scripts are meant to be thrown out anyway. But Lisa, you walked us through all these different careers you had. Heinz as a developer, Skanska as a construction, all equity construction developer. But then also you dropped in a 1 year as a funder of prop tech. So Steve Weichel and James are all excited about that.
And 5 years in private equity. Don't forget that.
And then I was going to mention that. So where have you ended up? Tell us a bit more about Oxygen. Oxygen Real Estate. I went to your website, and it's just an amazing smorgasbord of different things you do, but I couldn't quite
You name it, we do it. No, I'm kidding.
I couldn't quite tell what the business model was. Can you give us a pitch?
Yeah, I mean, so we started the platform a year and a half ago, and largely we had asset management responsibilities already with some lenders that have assets in trouble, but ultimately we want to use it as an investment management platform. So we're chasing dislocated deals. So my partner Chris Doman is a former Tishman Speyer guy. He ran the Northeast on asset management, sat at the debt desk. And so really we're seeing a lot of opportunity in the marketplace for what I would say, which is really interesting. These last 10, 15, maybe even 20 years have created a breed of real estate people that are largely spreadsheet investors. They're not really people who touch and understand and know the real estate. I like to pride myself, maybe because a little bit of my background is being a little bit of a cultural anthropologist. You sort of understand what's happening with the grid. You understand the bones of a building, of what's going to work, what's not going to work. And so when people take back these assets, they really don't know what to do with them. And in many cases, LPs are taking back, assets from GPs because there's, the GP no longer has a vested interest other than figuring out how to spend more money on CapEx because there's great fees to be earned. So we'll come in, we'll actually advise the LP, we'll earn fees on these
You know
types
how
of
a promote
things.
works, and then
All of it.
out of the
Exactly.
money, promote is not a pretty thing.
Yeah. So, I mean, a little bit of what Hamid was basically saying, well, we started off as a consulting business, but ultimately we're building an investment
Mead was
management
supposed to be
business.
on our panel, by the way. I think all of us are relieved we're not trying to talk to Hamid in
Yeah.
big screen while
Yeah.
we're chatting with each other. But that's really interesting. So there are 4 or 5 different ways you get in,
Right.
get invited in, or work your way in, or invest your way in to
Right.
what sounds like a real.
Because a lot of these, cap stacks are broken. And to Wayne's point, like, we'll come in and we'll bring pref equity and expertise. We're also, bidding on deals of where we'll just create an SPV, a special purpose vehicle in which, to invest in, and we'll take GP capital because if you're buying a 50 or $100 million deal, the GP position, is $5-10 million bucks. I don't have that to invest in like 10 deals. So there are GP players out there that want to improve the amount of promoter take or return that they're going to take for a little bit more risk. They're going to be on to, some of the guarantees of the loans and things of that nature that'll help, right? So we're kind of a little bit of the opposite side of the equation from Wayne. But yeah, I mean, I think largely our whole thesis is that cities, I think, are going to really change over the next 5 to 7 years, just culturally, dynamically with how we use them. I mean, some of Bill Wheaton's research is sort of showing sort of the dynamics of what's happened with housing pricing and commuting patterns and so forth. I think the nature of the way work is changing. The use of these assets is really going to shift. And so how do you play into that shift? And that's really the space that we want to play into. We want to help people who have distressed assets that really don't know who they are today.
Well, there you go. If you've got a deal for it, I'm sure you'd love to hear about it afterwards. Oliver, coming back to you, thinking about your dad, Oliver T. Carr, and his enterprise, well known to many people in the room. You decided to go your own way, and you raised capital 2 or 3 different places. You went public. You got taken private. You have the big purse strings of J.P. Morgan to fund you. And yet that company that you founded continues to evolve and change. And you mentioned in our prep call that you're in the middle of a new change yet again. Talk to us a bit about that. I mean, I'm imagining that when you were listening to Hamid, you were hearing a lot of echoes for what you're trying to do. Could you explain it?
It didn't instill a lot of confidence when, like 30 seconds in, Hamid's like, "Well, of course we got out of office." Like,
why wouldn't you?
I'm a slow learner, obviously, but I actually think there's a tremendous amount of opportunity in the market today. So, and what we're seeing in office, office is not like a one size fits all business. So you're seeing the big bifurcation into quality assets and everything else. We focus very much on high quality, amenitized, new, sustainable, great office buildings. And I think there's always going to be demand in that segment of the market. And, as to Lisa's comments, we're seeing some very unique opportunities out there to buy good quality assets at distressed pricing that we think we can then convert to be great buildings. So it's all about kind of the good to great strategy within office. And I think that sector within office is going to be fine, even with all the change going on in the business. And office is not without risk. I mean, over the horizon, we've got potential AI impacts coming. So it's a tough business, very, very capital intensive. I think our leaning will be more to build and brief hold and then exit versus maintaining, a portfolio position for a long time. So our orientation is, moving to be a little more opportunistic and value add. So on the other end of the kind of good to great office strategy, there's a lot of opportunity to buy failed office and repurpose it or redevelop it into something else. And frequently we're seeing that's multifamily. So we've got a healthy portfolio, or I should say pipeline, of mainly suburban office to residential redevelopment opportunities. And that's mostly And we all read about, converting office. That can work, but much more often we're looking at, you unfortunately need to scrape the existing, office improvements because the floor plate doesn't work efficiently for housing. But then build, purpose-built, ground-up multifamily. And that's a big opportunity. So we're doing a lot of that in the suburbs of the DC area. We're looking hard up here in the Boston area. So it's kind of fun to look at what is
right in line with what Bill was just talking about. We're bringing the workers back to suburbia, but in a more dense mixed-use setting, it sounds like, too.
Yeah, but it's basically the sector's broken. So what's the opportunity? And it's a barbell approach. It's high quality, and then it's take the bad stuff and redevelop it into something else.
Okay, so it's interesting chatting with some of the recent, I taught at MIT in 22, 23, 24, and several of my students here are all working at Tishman Speyer. And they're actually helping create Larry's dream of an innovation center over in Alston, maybe competing in some weird way with MIT and its preeminence as an engineering school. The three or four of you, Adam and Rohit, are working on this ambitious plan of Harvard to create an innovation hub across the river from Harvard's campus over in Alston, Brighton. My question for each of you, you got a real estate development degree. How much has the development been part of your life? I think we already know the answer from you, Lisa. It sounds like it was a big part. But how about you, Wayne? How much of your pipeline is in development? And even though maybe it's a small part, how has that experience of going through the CRED program helped you in your career to understand all the complications of building a building?
Well, that's a great question. I think the development side, so I am not a developer. That's one thing I know about myself. And my company today is focused on acquisitions. But I think the degree, it gives you a certain credential that really, when I was on Wall Street and folks are looking for real estate expertise, it always helped me. I could go back to that credential, go back to my formal training in real estate, valuation, understanding a little bit about construction and design. Although we just kind of scratched the surface here at MIT. To really learn those skills, you have to really do it yourself and develop. And that's where the real learning occurs. But where I've really used it is actually in my not-for-profit work. I have had the opportunity to sit on a lot of school boards and hospitals, and they're always looking for real estate expertise. And so having a little bit of development, I'm working on a $100 million, medical office development in Los Angeles right now for a hospital board I sit on, and it's just great. I'm really enjoying the development process, even though it's really not my expertise. But there's no doubt the degree is worthwhile. And it's not for everybody. I've given advice to my kids. One has it, one does not. They're both in real estate. I'm not sure if that's a good thing or a bad thing, but they're in real estate. But I've leaned on it many, many times.
Oliver, what percentage of your portfolio is in development now versus a standing investment? And how do you see that shifting?
Yeah, so today, probably 20% of our assets, something like that, are in development. We've got a couple of multifamily projects underway. But of what we own today, we built like 80%. So we are, I love development. We're really a development-oriented company. And the foundational education I got here at MIT really gave me the confidence to move in that direction. And it's all, Wayne mentioned it early on, it is all about the people. We've got an amazing, very highly skilled development team. But in that business, if you buy land right, you have a great and differentiated product, you can create a lot of value. So it's been key to our growth over the years.
Lisa, just maybe building on both of their comments, how important has your development skills been to you? Your background in urban planning and now in real estate finance and then in prop tech, how do all those three intersect for you in your startup Oxygen?
Well, I think the sort of the foundation of value in real estate, comes down to a little bit of replacement cost and understanding the components that build up to that. You know, I guess, you know, I think like I just sort of think about the building blocks. You know, everything in real estate is obviously depreciating at some point in time and is going to have some kind of capital reinvestment, and understanding, you know, the bones that sort of build that is really important beyond just sort of understanding income and cap rate, you know. And I think like supply, you know, understanding and dissecting the supply side of, you know, any asset class or any market feels to me very, very important. I think the office market, for one, you know, I remember when I first got into the business, everybody needed a 25% pre-lease. And then suddenly in the last, you know, 5 years or 3 years leading up to COVID, people were kicking off, you know, building spec left and right. And, you know, maybe a lot of that had to do with you know, the Tax Cut and Job, you know, Act that basically sort of allowed a lot of the tech companies to sort of write off, you know, software employment. And so it really boosted employment, and everybody was like hiring like crazy, and you just felt like you had to supercharge, you know, all the real estate out there. But I think there's going to be a lot more discipline, you know, relative to that. So understanding supply and the mechanisms of supply and what contributes to it, I think is a big determinant of value, and also a big determinant of like investment cycles for real estate.
Yeah, and it sounds like you're involved in trying to dissect a lot of deals that have changed with the rise in the cost of debt, the change in the credit conditions. The whole world has changed from 2018 to
Employment structures,
today.
you know,
Yep.
city structures, a whole mess of it.
Right. And just keeping in mind that our theme is the state of the industry, and think about some questions for the panel or some comments. So many of alumni are working in the same vineyards you guys are, and it'd be great to hear some of your thoughts from the audience. But just right now, where it's such an interesting time, and interesting in quotes, with a high cost of debt, much higher than it was recently, although much lower than when the Center for Real Estate was founded in '85, when interest rates were double digit. I mean, in a way, we're relearning how to make money, not just through leverage, not just through cheap debt, and that may be a good thing, but also all the different noise coming out of your hometown, Oliver, Washington, D.C., and all the different strands of turmoil that you need to understand to have a courage of your convictions, whether it's tariffs or changes in tax policy. How do you know where to focus, and how do you focus? Lisa, do you want to tackle that one first, and then we'll go right down the line? Yeah.
I mean, I think the core focus is oxygen, which is really cash flow. You know, you focus on things that are actually cash flowing or have the potential to grow the cash flow or improve them. I mean, those are the types of assets that we're focused on, and we're focused on improving the cash flow of assets that we're responsible for. I mean, there's so much volatility right now that you're not going to be able to control cap rates. You're not going to be able to control, you know, some of the things that actually going to have a lot of volatility. So what can you control is, you know, the things that you understand will have strong positive cash flow. I mean, in housing, we've underbuilt housing for the last 40 years. I would expect that to be fairly strong over the years to come. You know, industrial seems to be, you know, key markets. I think, you know, in tight markets, office can be, you know, a strong component, because essentially people still need to kind of gather together and create. But to me, it's cash flow.
Yeah, you need that. You need the cash flow as the people come together and create, and you can't lose it all to tenant improvements. Oliver, how do you answer this tough question about all the noise in the market, and you're CEO, co-founder of a company that has lots of micro decisions to make every week, every day? Where do you focus, and what do you focus on?
Yeah, so we see huge opportunity in the market today. So we're actually really trying to play offense, because this is a time, you know, that I last saw kind of in the, you know, during the major financial crisis, like early to mid 90s, with all the bank failures, a lot of distress, and property being sold at rock bottom prices. So today's different, at least in office. You've got to be selective. It's not, you can't just go buy any failed office building and think it'll be successful. Back to, you know, my earlier comments, it is all about quality today. That's what you know, what tenants and companies want. But we think now is a great time to buy. And so we're trying to buy at distressed prices. We're very much evaluating where current pricing is versus replacement cost. I talked about the suburban to multifamily redevelopment opportunity. I mean, you've got failed office assets that are frequently in main locations that are really hard to ever buy when the market is healthy. And you're able to buy those buildings at like $70, $80 a square foot, and that can underwrite really well for different forms of residential. So, you know, and if you can underwrite and make deals work today at current interest rates, I think that should give you a level of comfort that, you know, you're likely to benefit as the economy normalizes, if it normalizes. Hopefully it does. But so we're very focused on replacement cost, development opportunities when we see a fire sale in the market.
Wayne, just picking up on this, thinking of when we were with you in Santa Monica, it was 3 weeks before the fires. It was after the election, but before the pronouncements from the Trump administration on ICE raids and immigration crackdowns started to happen. And LA is kind of this epicenter, whether it's your governor or whether it's just the collection of things that you have to think about every week in Southern California, particularly in terms of what do you do with all that noise, all that turmoil? Do you ignore it? Do you develop a macro view like Oliver just said and just keep moving on, keeping on? How do you sort of digest all that? A lot of it bad news that's hitting some of your markets.
Yeah. I'm probably going to take a more macro cut on it because it's what's happening in Los Angeles is pretty disruptive. But I think, you know, Ollie and Lisa have kind of nailed kind of, you know, at kind of the micro, you know, real estate. This is what they're looking at. Macro, I'll just answer it. This is what's concerning me right now. It's asset inflation. It's not price inflation. And if you look at, we're inflating assets again. So if you look at the stock market, you know, earnings are, you know, earnings guidance is down. We're looking at P ratios are close to, you know, 22 times versus 18. And, you know, earnings are expected to, you know, be at 4.9%, which is on a negative trend. Just tells me that values are stretchy right now. Go to the bond market, same thing. You know, spreads have compressed. And we've got 3 wars going on. We have massive federal deficits that need to be financed. This is kind of a yellow light for the bond market. So then you get to the one I'm most worried about, and that's the housing market. And we're starting to see some weakness in housing right now, just given interest rates. New home starts are on the way down 1.2, and we're seeing some price. Some prices have fallen back a little bit. So that gives me concern that if there is going to be a correction, we're probably going to see it in housing. So I'm watching that very carefully. And when asset values are inflated to this kind of level, it may have an impact on consumption. So we're watching that. But the LA noise is it's very regionalized, and you know we kind of have to look at kind of these more macro concerns as to how it's going to impact our real estate valuations.
And I must say, that although you end up in the headlines a lot, very quietly and competently, LA is still a huge hub of activity across a whole wide range of industries that aren't in the headlines, whether it's film and media, technology, healthcare. And yes, the Port of LA is not as active as it was last year, but you still have a lot of great fundamental drivers there that aren't getting as much attention. I wonder too if Oliver, you and Lisa could contemplate what the tariff threat might mean to a development pro forma or a redevelopment pro forma. Have you looked at that? Whether it's steel, labor, all these things, they just, I mean, the common macro wisdom is it's inflationary, and it means the Fed can't do anything. Their hands are tied. And does that show up in a development pro forma? First Oliver, then Lisa.
Absolutely does, Jacques. So inflation in terms of what it'll do to construction costs, we're still in the early days, I would say, but we're underwriting, you know, we typically have a, you know, project contingency, change order contingency, but we're now building in a big tariff inflation add-on to any project we look at. I mean, you have to, right? Because there's so much uncertainty out there. So it's definitely affecting how we underwrite. And then it's created a big pause in the capital markets. It's challenging today to raise institutional capital for development because most investors are on the sidelines looking like, hey, how is this actually going to play out? So there's a lot of uncertainty out there. I'd say, you know, in a very real world example, we closed on a multifamily project and started construction like in January of this year, like just before a lot of the tariff announcements had happened. So as soon as that came out, we went in the tank, we worked with our contractors to kind of understand all of our pricing risk. And the outcome was more positive actually than we expected. When you think about, and I'll keep it brief, Jacques, but when you think about construction hard costs, that's actually 60% labor. Okay, so it's 40% materials, 60% labor. And then within the materials, there's the ability to replace a lot of your goods from different parts of the world and manage down your cost exposure. So after the full analysis was complete, we only expect like a 1 to 3% increase in our hard cost. And then you overlay that supply is way down, and a lot of subcontractors are looking for work and are afraid to pass through cost increases. So far, it's had no impact. Over time, you've got to budget appropriately and be careful. But that's how we see it today.
Lisa, any insights from you on that? Would you agree with Oliver? Not yet, but watch out.
Yeah, you know, we were sort of actively pricing a office to resi conversion the time Liberation Day came in. And so, you know, a lot of the capital that we were pursuing to kind of come into the deal was very concerned about sort of costs. I also happen to sit on a board of a very large construction company. And so we actually had the math, you know, of what it meant by market. And I think in our market, it was about 50-50 in terms of cost and labor, could be different in different markets. And we were sort of seeing, you know, I think that the general consensus was that we were thinking that some suppliers would sort of raise their prices to kind of match sort of the foreign competitors because essentially there was an opportunity to do that, but a lot of that had to do with how this stuff got pushed. So we were pricing in a 5% increase for tariffs in addition to sort of like inflationary stuff that you normally account for in your pro formas. So, but you know, the fact of the matter is if you incur it or don't incur it, the fact of the matter is you're buying a deal based upon the fact that you have to have this contingency because your capital wants it. So just this uncertainty was creating some price increases for us and, you know, an ability for, you know, where we could bid it. So.
Okay, they're giving me the 10-minute sign, and you guys know my final question, so I'm not going to go to the final question until we get maybe the lights up a little bit and just see what the room wants to hear about. Any comments or questions are very welcome. There's a roving mic around. Adam can get it to you. Anything that you've heard that you want them to talk further about, or I'll keep going. I've got a whole script of questions here. Yeah, we got one in the back. Thanks.
Yeah, great. Hi, thank you. Elise Salinger, 2016. I'm hoping you can expand a little bit more on labor and demographics. You talked a lot about tariffs and material, but talk about your weak links that you're seeing today and in the next 10 years as demographic changes come and immigration changes come.
Who wants to kick off on that? Lisa, I'm going to ask you, with your urban planning bones and instincts, I'm guessing you think a lot about that question.
Well, I think a lot about in terms of where labor movement is happening. And because I feel as though, I mean, certainly we see the correlations between, you know, hiring and jobs, you know, what happens in the residential market, retail market, all those sorts of things. And so we pay attention to sort of job growth in general. You know, and I think, you know, it's interesting because we're in a really sort of interesting time where I think there was a lot of, you know, during COVID, people sort of changing locations for lifestyle needs. And we're also seeing sort of a lot of, a fair number of layoffs that are happening. And so will you start to see people aggregate or move towards where, you know, hiring happens? I'm kind of in a wait and see watch mode, but I do know, you know, all the sort of like South migration that happened in, you know, from New York to Florida, it was sort of flocking back to in New York, and we're sort of seeing the apartment numbers in New York, kind of go through the roof in terms of the inflationary cost and the cost of housing in New York, because New York is full on and people are in the office. And I wonder sort of about the Southeast. I wonder about like AI sensitive markets where, some of the banking institutions and so forth have put all the sort of the centers of their processing, like in places like Dallas and, other places like Atlanta. Are those labor forces more prone to sort of impacts of AI, or are sort of the software development, related, professions? There's a bit of debate of whether the layoffs that are happening, the Metas, the Microsofts, the Googles of the world are AI influenced, or if they really are, related to the fact that you can't like, write off your R&D and your software engineering costs. And I think it's the latter. So I'm going to pay attention to sort of what happens to these kinds of things, but I follow labor. Labor is sort of a key factor for me.
That's a good answer. And Oliver and Wayne, both of you have targeted outside of your home markets. Both of you, it sounds like, have targeted Texas, Austin in Oliver's case, and Wayne, you've done a number of deals in Texas. Texas actually, unlike California, was a big positive source of in-migration in 23, 24. And in 25, there's a big question. You had 2.8 million immigrants into the USA in 24. That number will likely go negative. All with deporting and the board. And Texas relies so heavily on immigrant labor, not something that the governor talks about very much, but it's true. So how do you read that situation in, say, a market like Texas? Oliver.
Yeah, I mean, it's a great question. I mean, there is a lot of noise in terms of labor shifts, demographics that Lisa alluded to. But I think Texas and the Southeast over the long term, I feel pretty good about. When you look at Austin as an example, their population has doubled every 20 years for the last 100 years. So it's a very long-term trend, and I think that's driven by quality of life, tax policy. They're very good at actually trying to attract companies to move into Texas. It's a very good kind of recruiting state, and Austin is highly effective at that as well. So I'm pretty positive on that part of the country over the long term. We've learned they like to build a lot, so you have to kind of hit the pause button while all the supply wave hits. You got to let the water recede, and then you can go back in. But yeah, over the long term, I'm a believer in Austin at least.
Wayne?
Yeah, I'll be brief. I'm a big believer in Texas. I used to live in Dallas. I've done a lot of business in Dallas. I just follow the data. So we have about 150,000 new jobs created this past year in Dallas. It will continue.
I think the number one in the country.
Number one in the country. Now, the negative, as Ollie's rightly pointed out, is that we have a lot of oversupply. But what's happening, and I'm watching this very carefully, is the absorption of that oversupply is coming back into balance. I measure whether a market's out of supply or in supply is percentage of total units, if it's greater than 5% or under 5%. And Dallas got up to about 7 or 8%. It's coming down. It's since it really kind of, it peaked in, Q4 of 2024, and now we're just absorbing. So that job growth, I think, is going to offset some of that very nicely.
Okay, I'm going to ask a David Geltner question. David's actually in the room, which is great to see you, David. And he taught for many years here how important cost of capital is to thinking about a pro forma and what alternatives capital have, and a weighted average cost of capital, debt and equity. And clearly, just in the last really 2 years, that cost of capital has basically doubled. I mean, you think about on a senior loan going from that 3.5 to 4 range all the way to 7.5 to 8, or if you think about where you can get your money, Wayne, Wells Fargo is going to not necessarily even going to lend you the 70% loan to value you were getting back when you were there. So the question for the audience is, what's happened to your underwriting? What's happened to your cost of capital, both equity and debt? And how does that affect what you do? Has that slowed down or shut down your deal flow in some cases? Or are you still finding plenty to do, but with new, maybe higher rates of return? Wayne, you start it, then Oliver, and then Lisa, and then we're going to
Sure,
go.
you're hitting on a really important dynamic because the advance rates, the leverage levels are way down. So, and our values are down 20 to 25%. So you have to be very, clear, as what Lisa said earlier. It's all about cash flow and creating positive leverage. So we're at the point now in multifamily that we actually can buy down the rates. I'm getting a rate right now from Fannie at 4.89, and I'm buying an asset that's at 6. So yes, it's interest only. It's lower leverage. It's like in the 50s. I'm okay with that. I'm okay with that.
What term on that?
5 years, 5-year fixed rate. So as Lisa said, it's all about in-place cash flow. And the value trap is to trick yourself into thinking that cap rates are going to compress over your hold period. That's not going to happen. We don't pro forma that. We just say, this is what, it's like a good dividend yielding stock. Like, this is what it pays. And tell me what it pays, I can tell you what it's worth. And so that's the way the market discipline is really coming back, and it's positive leverage. You can't create positive leverage out of the box. Just, it's not worth your time. There's too many better deals out there that will create that right dynamic.
Okay, so Oliver, the JP Morgan guys up there in New York on their new building in Park Avenue, whenever they move into it, and they're all back at the office because Jamie told them, do they call you up and say, we need 200 basis points higher return? What's going on?
Yeah, and I didn't mention, we're actually going through a bit of a transition right now where JP Morgan is being redeemed out of the company, and we've got a large Israeli partner, Aloni Het. So they're putting
the
up
calls from Tel Aviv now.
calls from Tel Aviv, and it's amazing. They work and call even while the rockets are coming in. It's absolutely incredible. But yeah, but back to the cost of capital question. Yeah, I mean, interest rates have doubled, right, or more than doubled. Capital is repriced, I think, across all of real estate, dramatically within office. In office, access to financing is really tough. Very little bank financing. It's a lot of the capital today is debt funds and higher cost capital. So we need that market to normalize for more efficient pricing. We did just execute on a big permanent financing here in Boston on our One Congress project. We closed $650 million of debt at just under 5.8% for 7 years. It was a big single asset securitization. So I think that's a good kind of first, move for us in terms.
That's a Class A office, single asset.
Brand new, 15 years of WALT, kind of perfect asset. But we were really pleased to see the debt market respond positively to that. But other than kind of the pristine building, it's tough. And so I'd say equity returns within office and multifamily development are really 20%, in terms of expected IRR. And back to Wayne's point, the initial underwriting is all about what's the stabilized cash yield. I mean, everything is about the cash yield.
Yeah, and that development yield versus existing cap rate spread is probably widened back out again, having tightened up a bit. Lisa, any thoughts from you on?
I would just sort of say, like, I just remember sort of pre this sort of rate rise, the spreads. I mean, the spreads got so tight because people got really aggressive that they only needed like 100 bips between sort of, your stabilized and exit. On some of the stuff that we've recently priced, it's like back to 200, and sometimes more because the cap rate is a little bit more inflated of what they want, because of the uncertainty in the market. So I think, yeah, yields are way up from, as a result of this. And, I think, sort of the alternative, I've seen some of the the trades in San Francisco, because San Francisco is suddenly hot, again, for office, as we talk about it. But, still things are trading at $125 a foot or $140 a foot when, they previously were trading at 700 or 1,000. I just saw an asset that I sold in 2020, I guess it was 2019, for $1,000 a foot, just sold for 125.
Oh, ouch.
I'm glad I sold it.
I bet you are.
Yeah. And, actually Blackstone came in and
The
gave it.
Skanska asset.
No, that was Blackstone.
Blackstone. Oh,
Yeah.
yeah. Oh, EOP.
Yeah, EOP. Yeah, right. EQ, EOP. And Blackstone was the debt on it and provided 50% at like 350 plus SOFR.
Yeah, yeah. There's
So-
lots of interesting stories going around. The one I'm following is the Willis Tower. Have you been following that one?
That's my baby too.
Yeah. Well, the valuation on it is 1.4 billion or 900 million, depending on who you talk to. The lender valuation is 900 million, and it's just a
Blackstone says one.
and we were, certainly one of the funny things that fell out of that was Blackstone was saying all the visitors going, to Todd McGrath charging us all $60, Todd, last night to go. You can sort of start to see, well, maybe most of the Willis Tower value or a big hunk of it is in that visitor.
It is. There's 104 floors in that building, and the top floor of that building generates 25% of the revenue.
Okay, we got a 1-minute question that I prepared you 3 for it. And I'll just preamble it by saying I could see by Bill Wheaton. I was standing at the back and waving, saying, "I got a question for Hamid." And Bill, I couldn't see me because it's just all this bright lights here. And my question for Hamid is the same question I'm going to ask you. Why have you stayed in touch with MIT over the years? What has MIT meant to you? It's a great question for Hamid. He did his undergraduate degree in civil engineering here, MBA at Stanford, but he's continued to be a very loyal both giver, philanthropist, and stay engaged, and has been, whether it's Albert or Sichi, continued to take phone calls, or James saying, would you show up at 8 a.m. in San Francisco on a Saturday morning in a nice shirt and talk to a bunch of people you don't see? He says yes. So the question for you 3 is, what keeps you tied to MIT? What could MIT do more to keep you close? And what has MIT meant to you over the years? And is it different from when you graduated to now, today? I'm going to start with Lisa on this, youngest, then Oliver, and then the wisdom of class of 91. So Lisa, you're class of 95. And what would you say to my question?
I mean, I think if any of you guys know Chip Conley, he talks about sort of flow wisdom and sort of crystallized wisdom. And I think, when you first get out of MIT, it's sort of the network and the people that you collaborated with in the trenches, while learning all the great things that the school had to teach you. But it's also like leaning into that network when, stuff comes up. And I can't tell you how many times I've leaned into that network, whether it be for insight about a deal or some insight about, some organization I'm trying to get close to, so that's sort of like the
Staying
flow.
with Debbie Schwartz when you come into town.
There she is. So it's like a little bit of that sort of flow state wisdom. And then I think now, as you sort of move on to kind of crystallized wisdom, you're wanting to share and give back.
Nice.
That's simple.
Thank you for that. Well, we appreciated you gave back a lot today. So Oliver, what has MIT meant to you, and how's that changed?
I wish I'd come up with flow state, Lisa. That's awesome.
He's from the West Coast.
Yeah, exactly. Yeah, so for me, it was a really transformational experience. I mean, coming to the center really ignited my love for real estate and for development. And like Lisa's comments, it was the quality of the people in my class and the relationships. Many of us still stay in touch today. So it really was kind of my launch pad for my whole career. So I feel forever, I won't say indebted, that's a dangerous word, but forever thankful of the experience I had at the center. And if I had one wish or ask, I would love to see the center find a way to get more kind of entwined with the alums, kind of create more bridges, more more work together in terms of bringing the alums back. And I'd say the same for the connection with industry. The industry, I mean, it's a crazy time right now, and we need institutions like CRE more today than we maybe ever have in my career. So I think deepening those industry ties would be really a great opportunity for industry, also the students in terms of creating connections, job opportunities. So I'd love to see that as kind of the next chapter of MIT CRE.
That's great. Really well put, Oliver, and thank you for sharing that. And I'm sure James Scott was writing all that down, so you can expect to hear from him. Wayne, how about you?
Yeah, I would say, throughout my career, I had a lot of young people come and ask me, should I get my MBA? Should I get my real estate degree? And it's a very idiosyncratic question, and it's really dependent on individual needs. But those that want to go into real estate, and I can tell they have a passion for it, I strongly encourage it. Since MIT, I've been very passionate about real estate education on the West Coast, been very involved with UCLA's program, been on the board there, and involved at Stanford, trying to get Stanford's like 40 years behind MIT. I'm not sure I'll ever catch up. Trying to get real estate education, on campus there, making some headway. But I feel very strongly that real estate education starts with really good instruction, really good research. And I'm just so fortunate, Lindsay Galen, Barry, Gary, Bill Wheaton, Larry Backow, we just, all these
Was
professors.
Gary Hack, Larry Backow. You pulled the mic away. I'm just going to
Yes,
emphasize.
thank you. Were so influential in really shaping my desire to be, deep into this industry. So for that, it draws us back. And I'm fully supportive of the research and other programs that are trying to, build out real estate education for our young people that are,
Thank you for that, Wayne, whatever it is. Well, thank you. But please join me in thanking this panel. It's been awesome.